Yes, I am still buying real estate investment trusts. Yes, I'm still investing into my utilities. Yes, I still love them. So, what's going on here? Stick with me to the end of the video to find out what I think the future holds for this type of investment. Now, I like income, I like cash flow. Now, at the same time, I don't like falling asset prices, and I've had quite a few questions about this lately. Now, the big issue here is, of course, what's going on in the macro environment and the impact it's having on this type of investment. And when you begin to think about it, these high yield stocks are often viewed as a sort of a bond substitute. So, whenever you see the interest rates begin to rise, the yields tend to rise as well. And that means that the stock prices need to fall for the yield to rise. Now, at the same time, these high yield stocks often have a very capital intensive model, huge amounts of capital, heavily invested, locked up, and unable to move. Now, as these interest rates are rising, it also means that the ability to actually fund the cost of capital, that's going up as well. And so that's putting a lot of pressure on their ability then to get returns on that invested capital. Now, wrap all of this together, and we have a situation which is going to be very challenging for many businesses in this space. Now, what I've done here is I've come into Koifin and I've plotted a couple of the investments that we do have in our family portfolio, along with one that we don't have. So we don't have Safehold. But what we've seen is we've seen organisations like, for example, Crown Castle, Cell Tower REITs here decreasing quite strongly here in value. We can see Atlantica Sustainability also decreasing quite strongly here in value. We can see NEP, Next Energy Partners, also decreasing here in value, and we can see Safehold also decreasing here. Now you'll see they've more or less moved in lockstep here. We can see, yes, there's some variations, but broadly, largely, they are moving down. And as we can see, since the last several days, we've seen quite a strong decrease here over the August month of these prices declining quite precipitously. Now, when we begin to consider, are these companies profitable and what the long-term future holds? Yes, they are profitable. Yes, these companies are doing well. Now, in the case of Safehold, for example, they own the ground lease for an organisation. So an organisation like McDonald's or Starbucks or Macy's, they might take a ground lease, taking a very long term, maybe 50, maybe 99-year lease for that ground, and then they put their building on top. Now, when you think about that sort of period, those ground leases are going to be very sensitive to the interest rate changes as well. Very safe, very secure, nothing really happens to the ground largely, and so very safe, hence the name, Safehold. Crown Castle, for example, also a lot of money tied up, a lot of assets, a lot of equipment there. Atlantica Sustainability, Next Energy Partners, again, utilities, hugely capital intensive businesses. Now what I want to do is I want you to switch over to the analyst estimates. Now I've got Next Energy Partners here, and some of the things I want to see is I want to see the year-on-year change here in sales that is anticipated by the analysts, and I'm just going to worry going out 3 years here, and we've got a 21% increase this year for 23. 24 sees about 19%, 25 sees a 12%, 26 sees 13%. So we're seeing some nice, strong, continued growth here in the sales. Now, EBITDA as well, we can see double digits for the 23, 24, slipping down to single digits in 25 and 26. EPS adjusted, EPS gap, and we can see here as well the dividend per share also going up by double digits, sitting on top of quite a nice yield here from Next Energy Partners. Next Energy Partners has traded fairly well before the sort of 2021 COVID period, close to the analyst estimates. Here, the white line being the analyst estimates, the blue line being the share prices. In the last year, though, we've seen, particularly as interest rates have begun to spike and go a lot higher, we haven't really seen the analysts begin to decrease their estimates very strongly, but we've seen the share price, as a consequence, begin to respond very quickly. Now, when you look at this as well, you can see that the share price now has a 70% increase between the current share price and the analyst average target, compared to the peak of the COVID crisis where it was an 80% increase to reach the average analyst target. So from a historical perspective, it's looking very much here as though it's a strong and good buying opportunity. Now switching over to Atlantica Sustainability, we can see as well sales increasing year on year for 23, 24, 25 and 26. We can see slower sales increases, but we can also see generally healthy gains in EBITDA, adjusted EBIT as well with healthy gains, and some heavy increases in the net income expected also into the future. Now the dividend per share, we can see some small increases here of about 3 to 4% for 24 and 25. In terms of the price target, we can see that the analysts have been fairly aggressive in reducing the price target here for Atlantica Sustainability. We can see that prices are quite a lot lower than the average analyst price target, and in fact the difference here is plus 40%, which is quite similar to some of these other peak periods here as well. So looking like a time where the company itself is undervalued, but many analysts are holding on to this and recommending a hold only. It's important to recognise as well that the company has been undergoing a strategic review, and that may include the sale of some of the significant proportion of their assets, and that could also be used to help deleverage their balance sheet a little bit more as well. So what does the future hold next? There's still an expectation for additional rises. At least there is argument and disagreement. Now, obviously, a further rise is going to push the price of investments like those I've talked about. It's going to push the prices down. Now, eventually, though, those interest rate rises are going to reverse. We're going to see interest rates decrease, and therefore the value of investments like the ones I've talked about today, they will skyrocket. And my friends, in the meantime, I'm going to be collecting those nice juicy dividend yields, and when the capital appreciation comes, I am going to love it. What do you think? How well do these types of investments fit your investment philosophy and your profile? Let me know in the comments down below.